All right, so today we're here with Randy Weber of Guaranteed Rate, and he's going to teach us a little bit about mortgages and what that looks like in a home buying process. So Randy, welcome.
Thank you for having me, Ben.
So let's start with just kind of like what is a mortgage and why would someone need one?
Gotcha. So a mortgage in the simplest terms is money that we're going to give to a buyer to allow them to afford the home they're buying. So you take somebody out and they're looking at a house that costs $400,000. Most buyers don't have $400,000 of their own money to buy a house.
Very true.
So they come to me and they say, we want to borrow the majority of the $400,000 so that we can own this home and we'll pay you back every month with interest.
So can you tell us about the individual parts of, your mortgage, the principal, interest, and then escrow items?
Yes. So when you make your mortgage payment, every month when you send in your check to the mortgage company, some of the money you're sending in goes to pay the interest that accrued that month. Some of the money you paid goes to pay down your principal balance so that in 30 years you don't owe anything. And then some of the money you pay in goes into what we call an escrow account, which is where we hold money to pay your property taxes and your homeowner's insurance. So that when your annual premium comes up, the lender actually makes your payment for your homeowner's insurance. You don't have to make a separate payment, and same with your property taxes.
So now that we kind of understand what a mortgage is, I kind of want to introduce the three ways people can go about acquiring a mortgage. So can you tell us what those three are?
A bank is, a direct lender using depository funds, and you're going to be sort of limited to whatever the bank offers in mortgage programs. A mortgage broker is an individual similar to myself who acts as an intermediary for a lending institution, but that broker will close using that institution's money and in their own name. And a mortgage lender, such as myself at Guaranteed Rate, we close in our own name using our own funds. We get to underwrite most of our own files because of the volume that we do and how successful we've been in providing good mortgages. So we have ultimate control over the process.
I want to get into the individual products and
Sure.
what they are and what the differences are. So let's start with the two main products that people get, a fixed rate mortgage versus an adjustable rate mortgage.
Sure.
And tell us about those two.
So you got your fixed rate mortgage product, which we touched on a little bit earlier, which is your interest rate is set for 30 years, let's say, or you can also get a fixed rate for 25 years, 20, 15, but your most common is going to be your 30-year fixed rate mortgage. And that's done to give the buyer that sense of security and knowledge that I know what my principal and interest payment is going to be. The second one you mentioned, the adjustable rate mortgage.
Commonly known as
an ARM, A-R-M, adjustable rate mortgage. That's more popular for short-term home ownership. Let's say you bring us a buyer and they say, we want to buy our first home. It's a newly married couple with no children. They want a 2-bedroom place that they know they're going to outgrow in 7 years, and then they want to move to the suburbs.
Sure.
We can put them in a 7-year adjustable rate mortgage so that for that introductory period, that 7-year period, instead of getting that 4% 30-year fixed, they might get 3.5% on an adjustable rate mortgage. And as long as they're comfortable with knowing that if they stay longer in the home, that the rate will float and could be moving higher or lower, and they can always refinance as well. But if they're pretty sure that they're going to be moving on, they can take that bird in the hand, that 0.5% savings over 7 years, and that becomes substantial savings for your homeowner.
When someone comes to you and wants to understand, the pros and cons of a particular product, what kind of do you need to understand about their picture before you can direct them into a particular loan?
So that's a great question. There's probably 3 main things that I need to understand in order to help paint a picture for a home buyer, and that's going to be their credit profile. And I say profile because it's not just their score. I need to understand what debts are on their credit report. These are things like student loans, car payments, credit cards. It's not going to be things like your DirecTV or your electricity bill. Their income.
Sure.
And income can be a more in-depth word than what you might hear. It's important for me to understand how they're compensated, not just how much they're compensated. And then the last thing is going to be their assets. Not only liquid assets that they're going to use for their down payment and closing costs, but retirement funds that they're going to have as reserves. Not that you're going to want to tap into that for a short-term home need, but we want to know that there's funds available. So when I say pre-approved to them, I want them to understand the payment that you're looking at for the mortgage that you put in the system works for your credit profile, income, and assets.
Can you tell us call it 3 things to avoid, after you've gone under contract? Because I know there's a lot of pitfalls.
Yep, and you're right, it is 3 major things. Number 1 is don't change your credit profile. Don't take out any new lines of credit or anything like that. Number 2 is going to be don't transfer funds from one institution to another without the direction of your loan officer. And number 3 is going to be don't change your employment at all. Don't switch jobs, don't change the way you're compensated or anything like that. If you do those 3 things, then your pre-approval to closing will be much smoother.